everybody. We are going to get started. I know that you guys are still coming in and connecting to audio. This is being recorded, so if you miss anything from the script, you can go back and rewatch it. But I'm going to get us started here because we got a lot to cover today, and we're so excited here on a Monday after the Super Bowl. Did not think about that when we scheduled this. Welcome, everyone, to our Board Leader Certificate course, Day 1. The California chapters have revamped the program for 2025, and the Cal North and Base End chapter speakers enjoyed working together to prepare the program. We hope you learn a lot. We would like to say a quick thank you to the Education Committee for organizing all the speakers. We will post a link to CAI National's board member toolkit in the chat for you, but we will not be following this book as we have California specific information for you. I will be posting that into the chat as soon as I'm done with the script. Certificates for the course will be sent to the email address you registered with the name of the association or company you provided in your registration. If you need to make a change to that, please email me or reply to any of your confirmation emails. We couldn't do this without any of our sponsors, so we're going to let our event sponsors come on and have a couple seconds to say hello. First up is Associa Northern California. Are you here? Maybe not. We'll circle back. Next up is CID, and I see Brenda. We're going to let Brenda have a second.
Good morning, everyone. We're so excited to be part of the educational series. I know that Adam is speaking a little bit later on this morning. So CID Consortium provides full service community management services. We do specialize in accounting services for our folks. That also includes helping with any payroll items you have, as well as monthly financial statements, being available on time and expense basis if you need us for any consulting or acting as an expert witness. So again, we're very excited to be here this morning and look forward to the presentations today. I've attended in the past, and the speakers are usually very phenomenal. So welcome, everybody, and thank you.
Thank you, Brenda. And I know I saw our second sponsor, Josh from Good Life. Take it away, Josh. Oh, you're muted. Sorry. I just kind of threw that at you, didn't I? Let me see. How do I unmute? There we go.
All right. How you doing? Sorry for the technical difficulties. It is Monday and the Super Bowl was yesterday, so I need another cup of coffee. Thank you for having us. Let us be a sponsorship. We are Good Life Group. We are your local construction, restoration, pest control company, all in one. We do everything from your huge, bigger capital improvement jobs to fixing stucco patch or anything small. So we have a handyman division, we have a construction division, pest control, restoration. This is my first time here for this class, so I am excited, and let's go.
Whoop whoop! Thank you, Josh. Did anyone from Associa happen to show up while we were hanging out? All right, cool. Thank you to our sponsors. Please consider our sponsors when you are planning projects or need help in your community. Sponsors, please post your information in the chat for our attendees. They will also be get it via email at the end of the day. $5 Starbucks gift cards will be sent out to all homeowner leaders at the conclusion, and managers, sorry, at the conclusion of this event on Wednesday afternoon. A couple of housekeeping items. We are recording this meeting. Please keep your microphone on mute. We will be taking questions via the Q&A portion at the bottom of the screen, and should we have time at the end, we will be answering those questions, okay? Please make sure to keep them not too specific. Again, this year, if someone you know missed this course and wants to take it, we are recording it and offering it all year round. So if you are watching this recording at home in like June, congratulations, you're taking the webinar version of this course. We hope you enjoy it. Please make sure that your name under the participants list matches the name that you registered with, so first and last, so I can record your attendance, okay? Handouts will be posted to the chat once the speakers start speaking, and at the end of the day, you will receive an email from me with the handouts, with any pertinent contact information for the speakers, and you'll also receive a link to the YouTube video in case you missed anything, had to step away, whatever, okay? So again, yes, we're all adults here, so if you feel like you need to step away, please do, rewatch the video later. however you want. If you are taking this video live or taking this course live, you do not need to complete a quiz to get the board certificate. You just need to attend the classes. If you are watching this virtually after it's been recorded, you will need to take a short quiz in order to prove that you watched the videos. Okay, our first session is insurance, everything you really need to know, and SB laws, presented by Tina Keele of Socher Insurance Agency, Terri Guest of Berg Insurance Agency, and Alex Sohal of McGuire, Schubert, Sohal, LLP. Take it away.
Good morning, everyone. I hope everyone has had at least a couple sips of coffee because insurance first thing in the morning after Super Bowl Sunday, it's a rough one. It is a rough one. This is going to be a general overview, Insurance Basics 101. This is not going to be a deep dive. This is not going to be a current status of the market. This is not going to be a dive into the weeds kind of session. And as we all know, there are plenty of weeds to go through right now. And this is not it. This is just a general overview. So I am going to hand it over to Alex to discuss the
Yes. Thank you so much, Terri. Good morning, everybody. So we're going to just really jump straight into it. We've got until just before 10 a.m. this morning, so we want to try to pack in as much as we can while still keeping it as digestible as possible. So what you'll see here is sort of a big overview of what this entire insurance area looks like when it comes to CIDs. And by that, I mean common interest developments. So as an attorney, one thing, if you work with counsel, you'll always hear us talk about, well, what do your governing documents talk about? What do your governing documents say? What do they require? What don't they require? So one of the main things that we're always looking at when you are looking to figure out what your insurance policy should look like, what coverage should be there, is what do your CC&Rs and your bylaws actually say? Your articles of incorporation may also have some very basic provisions, but it's highly unlikely. But primarily your CC&Rs and your bylaws will be the big chunk of the language that you should be focused on. So generally what I see when I look at these documents is your CC&Rs will have an entire article that is dedicated specifically to insurance. That's going to be the different types of insurance if you're a condo project that homeowners are required to maintain, and also that the association is required to maintain. So when you're looking to figure out what your insurance needs to look like, you need to have your CC&Rs and your bylaws ready and available. One other thing that always comes with this is if you're an association whose documents are over 10 years old, you will want to take a look at revising your documents. Obviously, there's been a lot of changes with insurance over the past few years. There's been broader law changes over the past few years as well, unrelated to insurance. But for all of those reasons, if your documents are over 10 years old, you should have a review of those documents performed to determine whether they need to be updated or not. Generally speaking, they probably will. And if your documents are over 20 years old, I can say with a lot of confidence that they should be updated because there's a lot of changes that have happened since that time. Just a few civil code references that I wanted to go through because, again, this is what your governing documents will base their language off of. So Civil Code Section 5800 covers director and officer in liability insurance coverages. So the section of the Civil Code itself is quite large, but it can be broken down into a couple of very simple standards, which is that for any any community that is less than 100 units, you need to have at least $500,000 in directors and officers liability coverage. And for anything greater than 100 units, you're going to want over at least $1 million in coverage. Those are your minimums. Those are not your maximums. Talk to your insurance agent about what those numbers should look like if they need to be larger, because for some of you larger associations out there, $1 million is just not going to cut it. The next section that talks about the different types of insurance coverage is it's section 5805, and that's going to be member liability. And really this came up because of a case back in the day in which the court found, and this was prior to Civil Code Section 5805 being in existence, but the court at that time found that all of the members of an association were actually liable for damages for a slip and fall accident at the association. So in other words, that means any owner in that community would have been partially liable, at least, for paying that plaintiff for the damages that they suffered. The legislature, in a good move, didn't feel that this was the appropriate way things should be handled. And they adopted this, or they enacted the civil code section, which ultimately created the requirements for general liability coverage. And again, there are minimum amounts provided for in that section. You'll see here it's $2 million if you're less than 100 units and $3 million if you're over 100 units. And these are on an occurrence basis. That's something we'll get into a little bit later. Last section there is Civil Code Section 5806 regarding fidelity bond. And fidelity bond is something, that's the term that you'll hear a lot of, but really it's your crime, your employee dishonesty, any sort of monetary fraud related issues. That is what your fidelity bond is designed to cover. And there's no objective measure for how much that coverage should be. It's based specifically on the size of the association's reserve account, and then it's combined with the amount of your regular assessments over a 3-month period. So those are your 3 big civil code sections that, as an attorney, I always defer to, and as board member leaders and managers, you all will want to focus on when you're looking to determine whether your insurance coverage is adequate. Last few things here is just there's a couple of or a few federal agencies and lenders that provide for some minimum insurance requirements. We've all seen what Fannie Mae has done recently with respect to some of these. It's this questionnaire and a lot more involvement that it's requiring of associations to ensure that the coverage is appropriate and that the buildings are being maintained properly. So there's Fannie Mae, there's the Home Loan Mortgage Corporation, then obviously you got your flood insurance program. So these are all different agencies that require certain types of insurance, depending on where you are, what type of association you have, and what sort of risks are your association would be subject to. Last thing there is just exercising prudent business judgment. Ultimately, when I'm talking to a board of directors, you want to fulfill your fiduciary duties. You're going to hear that term being used a lot by an attorney, your duty of care and your duty of loyalty. It's very important that you rely on your experts, you work with your managers, you work with your insurance agents to make sure that you are covering your association properly. We're going to get into a little bit more of that here. I think Tina is going to jump into some of the Fannie and Freddie requirements.
Yes, thank you for that handoff. So recently, CAI hosted a webinar with Fannie Mae, Freddie Mac. These are your lending institutions. They kind of set the standard for private lenders as well. And we're learning that those private lenders, even when not a Fannie Mae, Freddie Mac loan, are starting to utilize some of these minimum requirements and application process and procedure. So we thought it would be prudent to include information on the Fannie Mae, Freddie Mac requirements and some of the new process by which lenders are going through to approve or decline a loan within your community. So some of the things that we've seen in the last several years are lenders are putting out a very broad application. And if you live in a homeowners association, I think a lot of this applies to, in a big way, condominium associations, but I don't think single family homeowners associations are immune to this. But some of the things that they are now looking at are if your community has experienced a special assessment. Really, the main purpose for that is to inquire if this is something that's related to a critical repair or hazard within the community. We obviously know that this was a big response to the Champlain Towers, failure in Florida. This instituted a lot of change within the homeowners association world. Reserve studies and lending were the fastest to act really as a response to that. And it was a huge tragedy. So I think these lenders are really looking at the stability within a community to ensure that they're lending to a community that's in good shape and proper repair, and that there's no hazards awaiting them for, a physical life-threatening catastrophe. So special assessments are looked at, inspection reports, if you've had any engineering reports, structural or otherwise within the last 3 years, they're going to ask for copies of those. They're going to go through those with a fine-tooth comb to see if there are any unknown hazards that they need to be aware of. And now that reserve study and funding plans are even more beefed up after the Champlain Towers, they're really looking at the remaining useful life of your components with your community. They're also looking at how well funded you are. So they're looking at the reserve study to see what components are coming due for either repair or replacement. And then they're looking to see if you have the funding ability to actually repair or replace those components, because we know that those components can lead to losses within the community. And they could be small losses, of course, but they could lead into larger issues like structural failure. Projects and litigation, they've been asking about this for years. So if you had a lawsuit pending, your lenders have been asking about that lawsuit. Sometimes it has to go to the claims adjuster, and they speak directly with that claims adjuster or attorney to find out the information that they're able to lend to see if it has something to do with a structural issue. ADR, litigation proceedings, anything in that fold are inquired about. And really what the lenders are trying to get at is, obviously, if you're eligible for a loan, but they have created a list that's an unavailable for lending list, and communities can end up on this list. It's kind of the list of communities that lenders are unwilling to loan to or lend to. This is a big issue with communities. So if you end up on that unavailable for lending list, lenders will not process a loan to units within your community. That's a really scary thing for homeowners who are trying to sell or refinance their units. And if you've had some big changes in the community and you have some members that want to leave the community, they're going to find it hard to sell, because the only people that can purchase in that community are going to be cash only buyers. So one of the biggest things that they highlighted, other than a lot of different coverage requirements, are the fact that if you end up on this unavailable for lending list, there are steps that you can take to get off of that unavailable for lending list. Most communities don't do that for whatever reason. And I think the main reason is they don't know that they can. So there are steps through Fannie Mae, Freddie Mac that you can go through. Their website is very chaotic, but they have a lot of information on there to go through those steps. You can look at their lending requirements. I know Terry's going to get in a little bit more of the coverage on roof actual cash value. That's a big buzzword right now in the lending world that can cause you to have some issues with lending. And for anyone who's interested, CAI, Community Association Institute online, there are national website for them. I believe you can go on and take that webinar about Fannie Mae, Freddie Mac lending requirements. So just reach out to one of us and we can direct you to that.
So now we're going to talk a little bit about the types of coverage, insurance coverage available and required for community associations. And when Alex was talking about civil code and what types of insurance are required, I don't know if any of you noticed, hey, property is not on that list. No, in California, property insurance is not required by civil code. Not true in other states, but in California, that's the case. So to figure out what sort of insurance your common interest development needs, you need to look back to those governing documents to figure out where what is required by the association to be insured. So if you look at your insurance policy, you're going to see building coverage. And that doesn't necessarily, well, it does mean the actual structure of the building. It might refer to some other things as well. And there's different sorts of definitions when it comes to your building coverage. And what type of building coverage you need should be hopefully outlined in your governing documents. The different types of coverage are bare walls, which is up to the uncovered sheetrock and uncovered subfloor of the interior units. And this is referencing condominium projects and some townhomes. Original builder specifications, which is how it was when the original developer turned it over to the association. And so basically, I like to paint a picture in people's head. If you were able to pick up your building, turn it upside down, and shake it, whatever falls out, the homeowner has to insure. Whatever stays in, the association must insure. Betterments and improvements, those are things that you have upgraded since the developer turned it over. Oftentimes, that's the responsibility of the unit owner to ensure, which makes sense because the association doesn't keep track of all those upgrades every time. That sometimes the governing documents do say that betterments and improvements are the responsibility of the association. Very rare, but we have seen it. And a peril, what type of perils are insured? A peril is the bad thing that happens, a fire, a pipe break, different sorts of things. There are 4 different types of insurance policies that refer to what types of perils are insured. Special form or all risk means that basically everything's covered unless it specifically says it's not covered. Like everything's covered except earthquake and earth movement. That's going to be something different. There's broad form, basic form, and then there's things called named peril, which is what we jokingly put in the unfair plan. That's our little dig because none of us really like the fair plan, but the fair plan is a named peril policy, meaning fire. That's it. That's the only thing that the California Fair Plan covers. It does not cover water losses or any other types of things that a normal insurance policy for an association would cover. I think we can go to the next slide. Your major exclusions are going to be earth movement or earthquake and flood. Actually, water is excluded on pretty much every insurance policy. Water of any sort is an exclusion, and then they add it back in by endorsement, and that's how you get coverage for sudden and accidental release of water, like a burst pipe or things like that. But in general, these are the types of things that most policies exclude or do not cover. Replacement cost and actual cash value. These are the types of things that Tina was referring to earlier that Fannie and Freddie are very interested in. Backing up for a second, when you're talking about insurance and what insurance covers, we're not talking about the real estate value of your home. Those are 2 different things. The fair market value of what you can sell your unit for does not equal how much insurance you should have for that policy. Those are 2 totally different things. What your insurance replacement cost is going to be is how much it would cost to replace or repair back to how it was before the bad thing happened, before the peril caused damage to that particular unit. That's what replacement cost means. They're not deducting for depreciation, and depreciation means, what it's worth now as opposed to how much it would cost to actually replace it. Extended replacement cost adds in a little bit more just in case, because when you first get the policy, the first day of your policy year, prices might go up before it renews again. So that extended replacement cost kind of takes into account that replacement costs are moving targets. Things change, prices change on things from day to day. Guaranteed replacement cost is great if you can get it. And that means the insurance carrier will guarantee to pay whatever it takes to replace the damaged property, even if it's way over the policy limit, as long as it was insured for the right amount in the first place. So if you have a building that should be insured for $10 million and you said, well, it's going to cost us $8 million to replace it, you're going to get dinged for that if the calculation was incorrect in the first place. But in general, a guaranteed replacement cost is great if you can get it. Actual cash value means the depreciation is reduced. And a lot of times depreciation is explained easier by looking at a car. You buy a brand new car and you've paid, I don't know, $40,000 for the car, and you drive the car off the lot and now it's not worth $40,000 anymore, right? That price is depreciated since you drove it off. That's kind of what depreciation means. Right now, roofs are looking at actual cash value. Many carriers are only insuring for the actual cash value of the roof. So if your roof is 10 years old and you have an actual cash value, the amount to replace your roof is going to be quite a bit more than how much that roof is actually worth right now because it's depreciated. But if you're reserving correctly, and here's your hint to make sure that you're reserving for your roofs, your actual cash value, hopefully plus how much you have in reserves so far to replace that roof, those two together should equal how much it would cost to replace that roof if something bad happened to it. And that's kind of how we've been getting around the Fannie and Freddie requirements when they get upset, because they do get upset when they see actual cash value for your roof. Blanket coverage versus scheduled coverage. Excuse me. Blanket means this amount of money is going to cover everything, like all your buildings, your pool house, your fences, all the stuff that's inside. That's a blanket limit. It's going to, you can use that money to replace whatever it was that was damaged. A scheduled coverage means you're going to assign specific values to each building, to each thing, and that's how it would pay out should something bad happen. So if you're switching from blanket coverage to scheduled coverage, you got, I mean, the math isn't as important, right, in your blanket coverage because you can use it however you want. Scheduled coverage, you need to make sure you have enough in each little pocket of values so that if something bad happens, you do have enough to go ahead and replace and repair that item. And also the last thing I'm going to say about this before we move on to the next slide is something called an SOV, or a statement of values. Every board should be getting a copy of a statement of values from your insurance professional. You should review it. If you don't understand it, ask questions about it, because you're going to need to sign off on it. And if you sign off on it and it's incorrect, that could have a negative effect should you have a claim. So ask questions, make sure you've seen the SOV and statement of values, and make sure you have that knowledge in your back pocket.
Well, we can't talk about building coverage and property insurance coverage or insurance in general without talking about deductibles, because that's generally the most commonly known phrase when we're dealing with insurance policy. So a deductible typically is going to be a per occurrence deductible. That means that if you have one large storm, you're going to have one deductible of $10,000 or $25,000, whatever your association's building or property deductible is. You have one large storm, it's going to be one deductible of $10,000. In this market, the standard deductibles are really becoming $10,000, $25,000 for condominium associations. Maybe higher, as Terri is alluding to. Gone are the days of the $500 and $1,000 deductible. In the soft market, that was completely common, and we would see that all the time. But we're really seeing where either associations are opting to go with higher deductibles, $10,000, $25,000, to save on premium, to try to prevent those small maintenance related claims from going on their record. And in a lot of cases, the insurance companies are requiring those higher deductibles. So it may not even be a choice that the association is making on their behalf or on their own. And so, but typically you're going to see a per occurrence deductible. We are seeing in this hard insurance market where you'll see a per unit or per building deductible as well. That is becoming a way that the carriers can insure a more risky community, but kind of decrease their risk a little bit. So the most common is to see a per occurrence or, one deductible for that storm, but we are seeing per unit or per building deductibles pop up on the middle risk, higher risk communities where the carriers are really trying to keep them insured, but take a little bit of their risk off as well. So you'll have also a situation where if you are a community that has experienced a lot of water losses, you may see that you have a water damage deductible for $25,000, but everything else is going to be a $10,000 deductible. So that's the carrier's way of also saying, you've had a higher risk with water related damages. So we're going to decrease our risk by instilling a higher water damage only deductible. Everything else will be a $10,000 deductible, whether that's a fire or, some other kind of peril that Terri talked about earlier. Anything that, hits your community, it's going to be $10,000, but water related issues are going to be a higher deductible. The biggest thing that we want to highlight when we're discussing deductibles is who pays the deductible. In your community, in your governing documents, you may have a provision that talks about the deductible. In the older governing documents, as Alex was highlighting, if you have an older set of governing documents, please get them updated. Typically, we don't see a deductible provision in those. In the newer governing documents, the amending governing documents, we will see a deductible provision. But if you go through your governing documents, your bylaws, your CC&Rs, and you notice that you do not have a deductible provision, aka who is going to pay that deductible in the event of a loss, you want to create a rule or a provision within your community that you have on file in your meeting minutes that talks about that. Historically, just as a good indicator, we would say that if it's something that the association was responsible to maintain and that failed, either due to failure to maintain it or otherwise, then the association would pay that deductible. If the unit owner was responsible for the component that failed, the unit owner would pay that. But we want to make sure that that's really clear at the time of the claim, and you're not deciding this once a claim has occurred. You want to set that deductible provision for before that occurs.
And one thing I just wanted to jump in really quickly, Tina mentioned that if your CC&Rs are silent as to who pays for the deductible, like she said, it is possible to create a rule or policy with respect to how that deductible will be handled. The key provision that Tina mentioned, though, is your CC&Rs cannot say who pays for the deductible, and then you try to contradict it with a rule or policy. So your CC&Rs have to be silent in order for that to be the case. So something I run into with a lot with boards, because we can't change the CC&Rs with a rule, but we can expand or clarify something in the CC&Rs with a rule.
Wonderful. Thank you, Alex. Yeah, he sees the back end of these moments where the association is scrambling to figure out who pays that deductible. And also, you have to understand that, if you say, okay, unit owner will, as the association, pay this deductible on this incident, if you have a similar incident, it might set precedence. So it's really important to have that clear from the get-go.
Can I jump in really quick too?
Sure.
Also, having these clear policies in place helps the unit owner get coverage on their individual homeowner's policy as well. So if they are going to get coverage to pay that deductible from their HO6 policy, having that rule or the governing documents in place that says, yes, I'm responsible for this, it helps them out. And it also, having a higher deductible helps share the responsibility for things like this. It puts a little more buy-in on the unit owners.
We do find that if an owner recognizes that they're perhaps responsible for $10,000, $25,000 in damages first, there's a little bit more care or control of their unit and the things that they're responsible to maintain, because they know ultimately, even though in a community association, you're all sharing the cost of insurance. So if your HOA insurance goes up, your dues go up as well. But there's a little bit more of ownership that occurs when unit owners recognize, hey, I'm responsible for $10,000 or $25,000 in damages before the HOA steps in. So we talk a lot about building coverage. That's the main hub, right? Whether it's a clubhouse in a single family homeowners association, or we're insuring large structure condos, townhomes, attached units. But there's a lot of other property within a community. There's association-owned contents, which when Terri gave that example of flipping things upside down and whatever falls out, the things that fall out are typically the contents or business personal property. So aside from building coverage, we have all of these other properties, right? Like homeowners association contents. That might be pool furniture, if there's an office, if there's a fitness center. You have all of these other components, these contents or property that we need to make sure is a line item on that. Lobby furniture, pool equipment. We have indoor and outdoor contents. Those can sometimes be covered in different ways on an insurance policy. So sometimes the building coverage includes outdoor contents. Sometimes it includes indoor. We have to make sure that that's all covered on your insurance policy. Security systems, a lot of communities are getting these high-end security systems with cameras, and it records 24/7, and you have backup tapes and all of that. So where we as insurance agents go to look at that other property is your reserve study. Your reserve study is a healthy outline of everything, including your buildings and what maintenance you need to do and have done. But it also shows all of that other property. And from that reserve study, we create that statement of values that Terri was referring to earlier. So we literally line item all of that property out. We assign a value to it based on what we see on the reserve study. And we should be communicating with you, hey, board, we have all these values on that statement of values. Does this look reasonable to you? Could you replace your entire security system with this value that was assigned in the reserve study? Maybe as your agent, we've increased that a little bit because we feel like that value is a little low. We're looking at certain locations in terms of your replacement cost value on your buildings. For example, how much it costs to replace a building in Sacramento is going to be different than how much it costs to replace a building in South Lake Tahoe. So we're looking at all those factors. But with regards to the reserve study, that's how we're getting all that other association property for you outlined and dialed out, so we know that it's included on your insurance policy. Right, so some other HOA covered property that communities often miss and just assume would be included, but we've got docks, swimming pools, bridges, your loss of association income. So if you have a large loss in your community, say it's a fire, we see that in California now all the time. If you have experienced an association-wide loss and your members are not able to pay their dues, you still have to keep your business moving. So loss of income or loss of association dues is a large component or piece of your coverage that you want to ensure you have a sufficient limit for. Typically, we're going to put 1 year of your association dues as your loss of income to keep that ball rolling, keep your lights on. If you experience a large loss like that. And it can be even a smaller loss. If you have a community, a condominium association, and you have a building that experiences a fire, and that may take a year to rebuild. Josh might, have an estimate on how long that takes to rebuild. It takes a lot longer than we would think. So having a sufficient amount of loss of income. We also have some communities that own vehicles or golf carts. And it could be a maintenance vehicle. They do, random maintenance within the community. Golf carts are used very frequently. And if you have a golf cart that is DMV registered as a vehicle, you would have to get a separate automobile policy for that golf cart. Same thing with an association-owned vehicle. And so these are all additional components of things we look at. A dock or a bridge is not automatically included in your building coverage. That's typically a separate limit. And some carriers might say, hey, we won't insure a full limit for that. Or we don't want the bridge or the dock. We don't want to take that. We'll insure for liability, but we won't insure it for property. And it's imperative that the board is aware of that so that they can add some funding for those components that are not.
Or the other way around, we'll insure the property, but we're not going to insure the liability for it.
Exactly. So I know that Alex has some communities with golf carts aplenty, and some fun stories from that. So.
Yeah. It's we're talking about here primarily is what the association's own insurance should look like. But one thing that does come up is what if your owners maintain, there's a lot of golf carts or what they're generally known as are low speed vehicles. That's what the vehicle code here in California references those vehicles as. So you want to make sure that not only are those vehicles covered by the association's insurance insofar as if there's damage related to your own property as a result of it, but making sure that the owners have their own insurance over those low-speed vehicles, the same as they would for any other motor vehicle that they would be driving. That's something that can come up from time to time, and it's one that the damages can be quite catastrophic And it's one that you want to be prepared for ahead of time rather than having to scramble after the fact.
Right. So the association needs to be concerned with the association-owned vehicles and ensuring that they have a separate policy if they're registered with the DMV as actual vehicles. Even if it's an unregistered golf cart, we need to at least make sure that there's some liability extension from the policy and that the golf cart itself is covered. But if you have non-owned golf carts in the community, you know, owners that have golf carts, and we've seen some pretty cool golf carts in these communities, that the association has some awareness as to liability exposure for that, and similar to maybe requiring an owner to provide proof of insurance for their unit. In an HO6 policy, you might ask for the golf cart insurance to make sure everybody's covered there.
Yeah, and it's typically done as a rule. So the board of directors can adopt a rule with 28-day notice and comment. So, and the language of that rule would essentially place those requirements on owners to not only have it registered with the DMV if necessary, but also insured adequately and to provide the association with that proof of insurance.
Wonderful. So along the lines of building coverage, we're talking about your clubhouse in your community or your multi-unit residential buildings, condominiums, attached dwellings. Building ordinance coverage or building law coverage is one of the most important parts of your insurance policy. It's a separate limit from your building coverage, so we need to be really clear on what this provides. So your building ordinance coverage really at the most important level is your code upgrade coverage. These days, especially in the state of California, you can have a code upgrade, you know, a couple of years after you build your structure. So I know now if you have to do a renovation in your home and it's to a certain percentage, you might have to add a sprinkler system, a fire sprinkler system to your home as a part of that remodel or renovation. So if you have a fire that damages your multiple units or just one single unit, there is a myriad of code upgrades that are a separate cost to the community next to just rebuilding that unit or that structure. And that's a separate insurance line item on your insurance policy. So we have coverage A or 1, depending on how your policy lists it, and that's for any undamaged portion of the structure that still remains. You have your B or 2, which is the demolition of removing that damaged portion of the community or structure out of the association, and then you have C or 3, which is your code upgrade coverages, which is arguably the most important. But your insurance policy might list that you have $10 million in building coverage. That has nothing to do with your undamaged portion, your demolition when there's a loss, or your code upgrade coverage. So it's imperative that you take a look at that separate portion. If you're looking at 2 insurance policies side by side, carrier A and carrier B, and there's a big price difference there, it could be that there's rating differences or deductible differences. But if they both say 10 million in building coverage, and then you go to your building ordinance and you notice that one of those policies does not include any building ordinance coverage and the other one does, I would obviously recommend the policy B, which would be the one that includes your building ordinance coverage or code upgrade coverage, because that is one of the most expensive items to in your repair process. And now the fun stuff, earthquakes in California.
Earthquakes in California. I'm not even going to say it out loud. Okay. We are quickly running out of time, so we're going to blow through this as quickly as we can. Earthquake coverage is similar to property insurance, but different. Because coverages for earthquake coverage, you don't have to have your full insurable value. So let's say your condo building, the total insured value should be $10 billion. You could choose to get earthquake coverage for $1 million or $5 million or $10 million. It's really, since there's no requirement, it's really up to what the association can afford and what you're comfortable with. Traditional earthquake insurance covers damage caused by an earthquake. That's pretty much what everybody is used to. But there's a couple other different types of earthquake policies that are available that pay out differently and might be more affordable for your community, depending on if you're right on top of a fault or not. So you have your traditional, which is what everyone's familiar with. Parametric earthquake insurance, it pays a set amount based on a value. So for example, it could pay you $10 million if an earthquake measuring 5.2 or greater hits within this distance of your community. And all you have to do is pass that threshold. So let's say it's 5.2 or greater within 25 miles of your community. If those conditions are reached, it automatically pays you out the full amount, the $10 million, regardless of whether you have any damage or not. This sounds more like gambling than anything else, right? Insurance is really legalized gambling, but that's how parametric policies work. Parametric policies are also available for wildfire, fun fact. So if a wildfire just breaches this invisible perimeter of your community, a wildfire policy might pay out. Different conversation. There's also buy-in or opt-in policies through a program called Modus, where it's a lower premium outright for the community association, maybe $500 or $600, and then the individual owners have the option of buying into that policy based on what their budget is, based on what their comfort level is. And that's a great option for associations who have earthquake insurance required in their governing document, but they cannot afford a traditional earthquake insurance policy. These opt-in programs in general, and check with your counsel first, but in general, they meet the requirements of those provisions. And then individual owners versus HOA as far as payouts, if you have individual earthquake coverage, then you're going to have earthquake loss assessment, because let's face it, if there's an earthquake and it's big enough and it causes damage, there is going to be a special assessment in your community, regardless of if you have coverage or you don't have coverage. There's going to be a special assessment to pay for the repairs or pay for the deductible to meet the deductible for your earthquake insurance policy. But regardless, there'll be a special assessment for that. Earthquake loss assessment on your earthquake policy, your individual one, will pay for that assessment that you receive. Let's see, and then choosing carriers. There's a lot of carriers. Almost all of them are non-admitted in the state of California as far as earthquake coverage goes. I think there's a handful of admitted ones, but most of them are surplus excess lines. AM Best is a company that rates the strength of a carrier, like a letter grade, like you see in school, A, B, C. You want to try and stick with the A's if you can. Some governing documents require you to stick with A's for all of your carriers. But when you're choosing your carrier, look at the strength of the carrier as rated by AM Best, and when you're deciding who to go with. And like I said previously, your total insured value may vary. Also, your earthquake coverage is going to be based on what your total insurable value is. And that's going to be regardless of how much earthquake insurance you actually get. So the carrier is going to decide your premium based on, you have a $10 million to replace community. Your total insured value is $10 million, but you're only buying $5 million of earthquake insurance. Your premium is still going to be based on the value of $10 million. Let's see, next slide. We're breezing through these really quick. Additional property coverage, we have mechanical breakdown or boiler and machinery coverage. And this could be your pool pump. It could be an elevator. It's going to be included in your property policy, regardless of whether you have a pool pump or a elevator. You're going to see that policy language. I had one board of directors get so upset. We have earthquake coverage and we're one story, and they got really upset. It's going to be included in the language of your policy, but you're not being charged for it. You're not being rated on having that coverage. The coverage is there because there's a standard policy language that everyone uses, and then you can change that coverage based on endorsement, adding things in, or take it away based on exclusions. Garage legal liability is also something folks see a lot. If your community has a valet service or is ever under the care and control or custody of vehicles, you need that coverage. I've been doing this a long time and I've only seen one association that needed that coverage. So a lot of folks say, oh, we have a garage, we need that. No, you don't need that if you have a garage. You need that if you have valets or people that are parking cars for you, or possibly if you're like, have those car lifts where you're parking one car over the other. And then flood insurance, that's usually going to be required by a lender if you need to have flood insurance or not. It's not required if you're in certain flood hazard areas, but it's available to anyone because everyone is in a special flood zone. If you look at the flood map, it goes everywhere. All right, I think
Alrighty.
we're gonna have like 5 minutes left, I think.
Yep.
Let's go.
We're gonna go through this one. So if you recall at the beginning of this presentation, I touched on Civil Code Section 5805. It references the minimum requirements for your commercial general liability coverage. So what you'll see there is for under 100 units, you got your $2 million per occurrence, and for over 100 units, it's $3 million per occurrence. So these are not your aggregate or total policy limits. These are your per occurrence. So it's extremely important that you make sure that whatever insurance policy you have complies with this civil code section, because it is on a per occurrence basis. And if you don't meet that minimum threshold, arguably you're exposing the members of the association to liability. And if that happens, then there's a potential breach of your fiduciary duties as directors, and the snowball just keeps going downhill, and it's going to be a pretty nasty situation. I'll skip over the middle 3 bullet points here, because generally these are all talking about the different sorts of damages that can occur, by which this Civil Code 5805 insurance coverage would protect. But the last one is one that usually gets quite a bit of attention, or at least there's always members or board members that are asking about it, and it's liquor liability. So what we're talking about here, the main difference is if the association is selling alcohol in any way, then the association should have a separate type of insurance, or the better thing is, if this is not a regular occurrence, is hire a third-party bartending service or liquor service to come in, because then you can rely on their insurance and their expertise, and that's a fulfillment of the board's fiduciary duties. If we're talking about circumstances where it's a board meeting, and afterwards you want to open up a bottle of wine, or perhaps you have some light, some beers or something as refreshments for people during a summer pool party, that's a little bit of a different situation. I would still refer to counsel and have that conversation to ensure that you're meeting your minimum requirements. But generally, the big distinction is going to be, are you selling this for money, or is this just you're giving these out as sort of a general hosting nature of being an HOA and running things? So those are the 2 big things there. On this page, I won't touch on it very much, but what it does is it covers your general liability limit. So you'll see one of the items that we didn't talk about was the medical payments, which you'll see is excluded. And that's something that you would run into if there's a slip and fall or some sort of personal injury that is involved at your association. If you have pools or if you have common area amenities like gyms, you'll want to make sure that whatever sort of insurance you have takes that into consideration. But I think with that, we can probably keep it going. Tina, I think you're jumping on.
Yeah, we're rushing at the end here, so we want to make sure we keep up for some questions. So directors and officers liability coverage, it's a requirement by civil code, and this protects you as a board of director. It should also, if you have a broad form policy, it should protect your committee members. Any board appointed committee member, board of director, that's within the community. It's for your act, error, or omission. Essentially, if someone doesn't like the decision that you made on behalf of the board. They don't think that you're acting within your fiduciary duty. You're not following the governing documents properly. And sometimes it just comes down to you didn't approve their architectural review request, and they don't like that decision that you made. This policy protects you as a board member. This is one of the most important coverage items. It's typically not that expensive, and it's going to cover you as past, present, or future. So you don't have to endorse your individual name on the insurance policy as a board of director. And it's essentially for the protection of the board. We do want to highlight one thing. If you are a person that owns more than two units, 5800E says that you are not protected under the directors and officers policy. So if you're essentially an investment owner within the community, a board of director, you want to look into seeking your own separate insurance for your own protection. That's a really critical item that a lot of people don't know about. And then just as a highlight to directors and officers coverage, we got this pie chart from one of the largest directors and officers insurers in the country. And this is the breakdown of the losses that we see. So you're going to see the most losses from breach of fiduciary duty. You're acting outside that fiduciary capacity. Violation of CC&Rs is the second most claimed issue with directors and officers, followed closely by breach of contract, typically with your vendors. I don't know if we have any time for war stories, Alex, so I'm just going to go to the next slide here onto our umbrella coverage. Oh, excuse me, fidelity bond coverage.
Fidelity bond, we've talked about it a little bit. I'm going to just say real quick, it's required by civil code. You need to have 3 months worth of your regular assessments plus whatever you have in reserves, then round up. I would also take into account what you're planning on putting in reserves over the course of the year. And by law, it has to cover your managing agent or your management company, and also include coverage for computer and fund transfer fraud. And we can go on to the next one.
Umbrella liability. In the event that your insurance policy for general liability is not sufficient to cover your civil code, you can get an umbrella policy or excess liability policy to extend over and meet those minimum requirements. In addition, if you have a large clubhouse and a pool and tennis courts, you want more than civil code, you would get an umbrella policy to increase those limits of liability to protect the community.
Workers' comp is required, obviously, if you have direct employees. If you don't have direct employees, it's still a good thing to have because it could cover you if you get injured as a board member. If you're doing a walkthrough and you slip off a curb and you break your ankle, it could provide coverage there. Also, committee members as well. Make sure you read the policy to be sure that your committee members are covered. And also, if for some reason you have a vendor or a subcontractor, they should have minimum requirements. You can see on the slide, if for some reason their coverage lapses or they don't have the coverage and the HOA does have coverage, it could come into play and save a lot of hassle and lawsuits. And then individual owner coverage. This is a provision, hopefully it's in your CC&Rs, that states what individual owners are required to insure. And remember, the requirement to insure is different than the requirement to maintain. They could be the same, but oftentimes they're different. So that should be in your governing documents, or you can make a rule or a policy, as Alex was talking after. Hey,
I'll just say that don't rely on your real estate agent to tell you what you need as an owner. Please go to the HOA's insurance agent, find out what the master policy covers, and make sure that you have your own individual policy to cover all those items that aren't covered on the master.
Right. I think we did it. Look at that.
I think we did it. So we're here at questions.
All right, guys, I have not received any questions in the chat or via the Q&A function. We have about 1 minute for questions. If anyone has one and would like to post that to the chat, please do, and then I will read it off. But great job, guys. That was a lot of information.
And there's our contact info. If you think of one at 3 o'clock in the morning when you wake up and go, I should have asked that. Now you have our contact info and you can shoot us an email.
But they will not respond at 3 in the morning.
Hopefully not.
All right. I think.
All right. Thanks,
Very good.
everyone.
Great job, guys.
Yes.
Thank you so
Thank
much.
you all
Thank
for attending, and good job for increasing your education.
Woo! Again, all of this information will be sent out after the program for you. If you could please stop sharing, Tina, for me. Thank you so much. Sorry.
Sure thing.
Okay. And we will make sure to get all the relevant links as well out there for you. But we have about a minute. I'm going to have our next speakers get all queued up. If you would like to step away, you have 1 minute. Again, we are recording, so if you need to step away or you want to like rewatch it when you come back, you can do that. It's very low key. If you step away with us, like with a laptop, please make sure your video is off. That'd be great. But I'm going to call up our next speakers, Adam Haney and Stephen Murphy. Let me find them, get them all up here.
Good morning.
Good morning.
Good morning.
We got a lot of information. This course is like jam-packed with information.
I think the participants might want to refill their coffee cups right about now.
Yeah, right? Yeah, go refill your coffee cups while I get everybody set up here. This is very
Rachel,
exciting.
if you have the ability to allow me to share the screen, I have our slides ready to go.
Yes, sir. I just made you a co-host. Thank you for reminding me. Okay, I'm gonna do a little quick intro though for you. It's because now it's 10 a.m. My goodness, this day goes by really quickly. Our next session is financials, budgets, responsibilities, and more, being presented by Adam Haney from CID Consortium LLC and Stephen Murphy from Allied Trustee. Take it away, gents.
Thank you,
Morning,
Rachel.
everyone.
Good morning. We have a lot of material to cover, similar to our insurance portion. And let's see, do we have the screen share showing up yet? No.
Yes, we can see it.
Oh, great. So today we are going to focus our conversation on three main elements of the financial cycle. Stefan's going to kick us off this morning with the planning session, where we're going to talk about budgets and all the things we need to consider while preparing those budgets. We'll then dive into the evaluation, or that time period while that budget year is playing out and you actually get to gauge how well you did in preparation of that budget, as well as how your entity is performing. And then lastly, we have to wrap up the end of the year with our audit, financial reports, and don't forget tax returns. So without further ado, Stefan, would you kick us off?
Certainly. Annual budgets, this is, aside from your governing documents, this is the critical component that board members will address every single year, because so much of your activities just are necessarily dependent upon this document, and it can be confusing. People with the background like Adam, I think if Adam were on my board of directors, I would be thrilled because you want somebody that has the ability to take a look at your documents and help guide other board members through it. So for all of you that are on this session today, I congratulate you. And if this is new information, then make sure you reach out to your resources, people like Adam and his firm, to help you walk through this process every year. Importantly, and that's why it's first up here, identifying anticipated expenditures. You want to have an idea of what your community might be looking at having to spend this year, so that you can plan for it. The better you do that, then the less impact those unexpected expenses will have on the rest of your budget. So planning and looking forward, looking at your community, working with your manager to whether it's doing a walk around the community, and we're going to dive into your reserve studies here a bit today as well. But the budget is critical. Also, it relates to our prior conversation on insurance, because of the way insurance premiums have been impacting communities this year. So working with your insurance provider for your budget this year and next year are also going to be really important. So once you're taking a look at your anticipated expenses, you're calculating the annual assessments so that you try to get as close as possible. When I talked to other board members in the past, think about how in your own paychecks, when you're trying to account for how much withholding you do with your federal and state taxes. So when tax season comes around, you're really not writing big checks. If you're calculating your annual assessment somewhat accurately, you're not going to be way over budget or way under budget in any way. And so that's kind of for those board members that are less familiar with budgeting, just that simple concept of, you know what it's like every year when you write a check to the IRS or the franchise tax board, you really want to minimize the amount that you're writing out. So pay attention to how much your assessment amounts are, can really get you in a nice, comfortable place. You shall assess a sufficient amount to meet obligations. And I know Adam and I have had conversations about words like shall when it comes into California Civil Code. Shall means you will. It's not you can or you have the option of. The Civil Code is saying you shall assess a sufficient amount to meet your obligations. So here, our legislature is encouraging us to be as accurate as possible. The board can increase your annual assessment amount by 20% a year without a vote, plus an additional one-time assessment of 5% of the annual budgeted expenditures. So you've got guidelines here that you can make increases. And I think a lot of us in the industry are oftentimes recommending that you just make increases. Yes, you're going to hear from your neighbors like, no, we don't want any more increases this year. Well, sometimes you just have to. Your obligation here when you're wearing your fiduciary hat for managing the fiscal health of this nonprofit organization, it means that, yes, as much as people and your neighbors, your friends that you're neighbors with, they don't want an increase in assessments, but sometimes you just have to. You also want to avoid special assessments if at all possible, because they can be a significant impact on your neighbors. People will move into a community. They may understand that, yes, they're required to pay their monthly dues, but it may be really a stretch for some of your neighbors when they buy into your community, and maybe they think they're all set and they're counting on you as board members to have that assessment amount, and it's hopefully not going to move up the amount too much from year to year. And so a special assessment, while it's certainly going to be a surprise to board members, you can imagine the surprise it may be to a family, a young family, or a retiree who lives in your community. So special assessments are a tool for a community to use, but you want to avoid it if at all possible. You're tracking actual expenditures versus budgeted amounts. So you have a water bill, and if there's an unexpected increase in any utility, whether it's PG&E or water, if that's an unexpected, well, then you've got to track that throughout the course of the year. Ensuring continuity of services. You want to make sure that there's money in the checking account to pay for all of these things so that you don't have to suddenly reduce pool maintenance, or you have to make a significant drop in the level of service to your landscaping services. Those are all really important. So monitoring on a monthly basis, what was the actual versus how much did we think it was going to cost? Critical as you go through the course of the year. This annual budget, of course, distributing within 30 to 90 days prior to the beginning of the fiscal year is a requirement, and a simplified example for illustration purposes to follow. So we've got a visual tool for you to look at. So here, and of course, your who you work with may provide it in a different appearance. This is just to give you a rough idea. In that first table on the left, we've got current year budget. So this just has some examples. It's got our regular assessment amount, what we anticipate annual and monthly income from not only the assessments, but interest. And so that we've got our revenues. But look down there at the expenses. And again, this may not include the expenses that are all rolling up to your particular community, but we've got everything from the management services and insurance, both premiums and deductibles, television, maybe there's elevator maintenance, trash, trees, and compare that to the middle column. And you can see this is where we're comparing actual, what's happening now versus what did we really budget for. And if you can see it, if you look down to, let's see, that's a good example here. 578. Well, tree trimming. You know, if we've budgeted for $12,000, but thanks, but we haven't spent that yet. So we could be significantly under budget. Is that because this particular month is not the year that we had contracted to do the tree trimming? Maybe that's going to come around to us in the fall. So we wouldn't see that necessarily right away. But in other examples, if we're way off and our expenditures this year are significantly more than we had budgeted for, then that also leads us to the last column, our next year's budget. We should be, if we're seeing an overage or an under, that can help us calculate what we're going to be tracking for next year. So as an example, if water bill is suddenly much increased because the water district, I'm thinking of just some recent Northern California news items up in Marysville and Yuba City, that the water district up there is implementing significant increases, double-digit increases over the next several years. So here we budgeted what we thought was going to be appropriate, but now this particular utility is significantly increasing. This is where you might see some increases in insurance as well. And so even though we're dealing with this year's budget, we've got to make some notes for next year's budget as well.
While we're on this slide, those are great examples of how you can use your current year experience to forecast the next year. And you definitely want to make sure you're covering as many bases as you can, because in this world today, there's one thing that's certain, and that is that you cannot predict the future as to what your expenses will hold. One of the things I'm noticing on this line before we move on is the reserve funding. And that is such a critical element that will be presented in the next section. Tomorrow morning, we'll hear presenters talking about reserve funding and this reserve study report. That's what's feeding this line, reserve study. And the reason I want to call that out is too many times I've gone to board meetings where the board wants to address that after they find out what their upcoming expenses will be and have a preconceived notion of what their assessment should be. Too often, reserves is a plug, when in reality, even though it's the last line on this report, it should be one of the first things you get knocked out and taken care of as you go into this budgeting cycle. So thank you for allowing me to chime in on that reserve funding piece, because it's just so important in the maintenance of your community and the protection of the value of your individual properties that you actually fund and execute on that reserve funding plan. I'll step back off my soapbox. Would you like to go to the loans from reserves?
Sure. And that Adam's comment about reserves, you know, you really have to, it's like paying yourself first in any good individual's home budget. You want to make sure that you have adequate savings, and that's what the reserve is all about. If you're not funding it, and you're going to hear some great information tomorrow about reserves, but you know, if you're not setting that money aside now, it means that you're either going to do loans from reserves to pay for all of the things that you don't have on the reserve study, or it's going to mean special assessments potentially. And again, you always want to try to avoid doing things like that to the best degree possible. This is important. Civil Code Section 5515, the temporary transfer of reserve funds. There have been some, I think sometimes board members get a little comfortable in thinking that, oh, we'll just take some money to reserves to pay for these things. So it's possible to do in certain circumstances, but it is certainly regulated. So the membership, everybody in the association must be notified that the board is electing to or choosing to take a loan from the reserve amounts. You've got to record it in the meeting months, and you have to repay it within 12 months. And Adam will stress this section E here, and here's our favorite word. The board shall exercise prudent fiscal management in maintaining the integrity of the reserve account, and shall, if necessary, level a special assessment to recover the full amount of the expended funds within the time limits required by this section. So we're stressing this because, again, a board with maybe a little more casual relationship with the idea of just taking loans out of the reserves, you can do it, but you have got to put that money back in there within 12 months. Adam, have you had some experiences with boards maybe treating this section a little too casually?
We sure do, and we discourage it as much as possible because it's stealing from their ability to perform their required major repairs and replacements when it becomes due or important to take care of those pieces. We also slip this in here as a timely piece relating to budgets because, well, the insurance presentation didn't get an opportunity to speak about our current market. We have seen many communities in the state of California experience dramatic increases. Not all, but some have seen extreme increases in their insurance premiums, which can have a dramatic impact on their annual budget. And for some of those communities, they've dipped into their reserve funds just to make the premium. They have a very short timeline and need to be able to cover their community. So the board will make a decision to take out this loan. And while you're talking about budgets, this is the perfect time to work in a repayment plan into your upcoming budget. So if you didn't levy a special assessment when you had to take the money out for repayment, then consider working that into your annual budget for the upcoming year.
Great. So here's the area that my company, Allied Trustee Services, works with a lot of our communities on. It's your duty to assess, Section 5600, the duty to levy assessments. Again, here's our word of the day, word of this segment. The association shall levy regular and special assessments sufficient to perform its obligations under the governing documents and this act. So I have been a member of communities where the overwhelming voice from the membership was don't raise our dues, don't raise our dues. And again, a rather casual relationship with a reserve study meant that our community was facing repeated and regular special assessments in the coming years because the board members that were in charge at my community at that time really didn't want anything to do with increasing assessments. And so they were falling deeper and deeper into the hole. Section B, an association shall not impose or collect an assessment or fee that exceeds the amount necessary to defray the cost for which it is levied. So this goes back to the importance of budgeting is you don't want to be assessing too much, and you definitely don't want to be assessing too little because of how both of those things can impact the economy. It's again going back to, are we looking at what our expected costs are? And this is why tomorrow's section on the reserve study is so important, is with a good quality reserve study, what you should be expecting. The community in which I live now, we expected to have to repaint. We did. We were not expecting the level of dry rot from timbers that were improperly installed by the original builder. So that was an unfortunate expense. However, our board members paid such careful attention to the reserve study and making sure that we were appropriately funded that we were able to pay for significant dry rot repairs from the funding that we had already set aside, and without actually having to do the loan for longer than 4 months, which was great. The responsibility as a neighbor is to make sure that you're not negatively impacting the rest of your neighbors with surprise assessment increases. And so that's why it's also important that you're not collecting more than the association needs to run effectively. It's a balancing act. Adam, have you had clients that have increased regular assessments too much?
I have. I love your example though, because it's a perfect story of how if you do your due diligence of getting up to date reserve studies, you incorporate the funding plan into your annual budget, and you assess the members a sufficient amount to defray your obligations throughout the year, then you'll be better prepared to deal with these little surprises that show up, even though dry rot, what didn't turn out to be so little in your community. And you're able to insulate those members from what would have otherwise been a special assessment. So, well, in the heat of the moment, preparing this budget, it might seem that the kindest thing you can do to your fellow members is to minimize the assessment increase and forego some of the reserve funding. It can actually have a detrimental snapback effect, if you will, if you find yourself with those little surprises that are just bound to come up. I haven't found many wood structures that don't have some form of dry rot when it comes time to paint. But you're right. There are cases where some communities will just continually increase assessments without paying attention to why. And I honestly have a couple clients that meet that criteria where because they just decide, oh, well, we ought to increase it at least 10% per year, they get themselves into a position where when you add up all of their anticipated reserve expenditures and their funding plan over the next 30 years, they're over 100% funded. And then you look at their operating expense and they have more than enough to meet not only current year expenses, but what's anticipated for the next year. There are cases where we have to talk to them about reining that back in and lowering the assessment to what they can actually justify. Because as Civil Code Section 5600B says, you can't assess for more than is necessary. So it's not I know it's a rare occurrence because every board member also pays these assessments, but these are guardrails for you. On one hand, you must assess a sufficient amount, and on the other, you don't get to just assess for the heck of it. So a great example. I love that.
All right, next
Shall we
slide.
move on to our next section?
Yes.
That is going to be the evaluation. So you have just put all this time and effort into budgeting for your community. And now you get to use that budgeting effort you put in as a tool for monitoring the health and performance of your association throughout the year. So in this phase, we're going to take a look at the evaluation. And this is the time period during the year we just prepared a budget for. As we dive in, we're going to take a look at a couple key reports. Before we dive into those reports, I'd like to introduce a term that some of you may or may not be familiar with, and that is the accrual basis of accounting. What that means is it's a fancy accounting term where we like to define or recognize revenues when they are earned and expenses when they're incurred. And the reason I have to define this is if we approach this just from an everyday consumer perspective, we think largely on a cash basis because we pull open our bank statement, we look at how much money we have, we might know that we wrote a few checks, we'll deduct those as they might be outstanding, but we're recognizing income as we earn it and it's deposited into our bank account, and expenses as we pay them, whether we incurred them in the past or we're paying them for the future. In the accrual basis of accounting, what we're going to do is recognize revenue when it's earned and expenses when they're incurred. That means that even though you may not actually get 100% of your assessments deposited during the month because some members have not paid, you'll still recognize the full amount of the assessments that the association has earned. And then you'll call Stefan up and say, hey, we need some help. We have some owners that aren't paying their assessments. And do everything you can to make sure that your membership is paying those assessments. But any balance that has not been paid will be shown as an accounts receivable balance on this balance sheet report. So assets, which are reported on this balance sheet, include balances that are owed to the association in addition to cash you already have in the bank. It might also include insurance. You typically will pay an insurance premium on an annual basis and receive the benefit throughout the next 12 months. Well, rather than charging the full expense of that insurance premium in month one when you pay it, you're entitled to another 11 months worth of coverage from that policy. And so the accounting entry that we'll do for that is we'll record the 11 months of insurance premium that we have not yet received the benefit of as an asset called prepaid insurance or other prepaid assets. So these assets that we're talking about include not only the cash in the bank that you can go and count or get a statement for, but also the amounts owed to the association and the benefit to those unexpired insurance premiums. So let's move on down that balance sheet. Another piece of the balance sheet is going to be a liability section. This is where we talk about what the association owes third parties. So you'll want to look at any bills that were for prior periods that may not have been paid during that same time. Oftentimes, utilities will be used or consumed during the month, but it's not until the meter is read and a billing is generated that you actually know how much. And then you usually would have seems like a shrinking amount of time to pay it, but you'll have a window of time to be able to pay that bill and not receive any late costs. Well, when we're on the accrual basis, we're going to record the expense in the period in which you used the utility. And then we'll record it as a liability to the association on the balance sheet. We typically will label it accounts payable. There are other liabilities that an association can incur, and that includes sometimes associations will go out for a bank loan. And when they do that, we need to report the balance that the association owes to the bank on that bank loan as a liability because it owes the third party. CID Consortium, we take that a step farther, and while you're learning about reserve studies in the next section, one of the figures they'll show you is what your current or fully funded obligation is. That's a calculation of how much the association should have in its reserve account if it were fully funded. Well, we'll record that as a liability because the way we interpret that information, the association has an inescapable contractual obligation to maintain the common area of the association. And we know about how much that will be because we have a study that prepares that for us. So when you compare the cash you have in your reserve account to the liability that your reserve study is presenting, we'll put that on the balance sheet so you can quickly see how you stand or where you're positioned. Equity is a term that sometimes is referred to as net income over a period of time. The equity is, one way of describing it is what's left over. If you relieve all of your liabilities with the assets that you have on the books. So if you take your assets, they'll always be equal to your liabilities plus equity or members' equity. And that's the accounting formula you see on the screen. The balance sheet as a report is telling us the financial position of the association at one point in time. Well, the next report we're going to talk about, the revenue and expense report, is going to show us the performance of the entity over a period of time. To show you that performance over a period of time, it's going to present to you the revenues of the association. Typical revenues for a homeowners association or common interest development will include, of course, assessments. That's the whole reason we went through the budgeting exercise, was to let the members know how much we need to collect from them so that we can pay for the next part of the report, which will be the expenses. But some other forms of revenue that you might find on the income statement or revenue and expense statement of a homeowners association could include interest income. Sometimes we see rental income, or even cell tower rental income or bulk utility programs. All those revenues are added up into the revenue section based on the time in which the revenue was earned. And then we go to the expenses, and that's where you're going to see your expenses like management services, water, sewer, electric, your accounting costs, the maintenance of the association. Most associations have some form of landscape that needs to be maintained. A contribution or the cost of the aging of the community in your reserve study, that reserve contribution is typically a line item. Now, here it's saying your budgeted revenues must equal expenses. There's a caveat to that. Well, generally, we want to make sure we're assessing a sufficient amount to defray the expenses, and usually that means we need to make that equal. There are cases where the association may need to assess more than the anticipated expenses for that year to either service a loan. If you have an outstanding loan, you need to pay down the principal balance as well as the interest. So that may be an item you need to add. And then another area you may need to add to that would be to catch up on your reserve funding plan. If you find yourself needing to contribute a little bit more each year, you may need to budget for a little bit more to be able to catch up on those reserve funding plans. So while your budgeted revenues typically equal the expenses, there are some exceptions there. During the year, we're going to take those budgeted numbers that we've prepared and compare them to the actual results so that you can see where your budget variances are. We're going to take a look at that as we flip through the next couple slides that have illustrations of the financial reports we're speaking to. So here we are, we're looking at that balance sheet. Sometimes it's also called a financial position statement. A lot of times the terminology just depends on what accounting software we're using. but they mean the same thing. Here we have our assets at the top. We're moving down to the liabilities and equity. Within the assets, we can see we have the checking accounts, our cash accounts from the bank. We have accounts receivable. That's money that our members owe to us or to the association. We can see the assets, other assets category has prepaid insurance. I know I'm saying we can see that. It is small print. I will see if I can zoom in here. So here we are. We have the prepaid insurance, prepaid taxes. And we'll talk a little bit about taxes later. And then down here, as we get into the liability section, we're looking at accounts payable, meaning the vendors that have sent us bills, but we hadn't paid as of, what's the report date here? As of December 31, whatever the financial report date is on this report. We had $21,000 in bills that we had incurred, but we had not yet paid. That doesn't mean we're past due, just means that we've received the benefit in the past. The advanced payments for members, I like to make sure everything's paid on time, and sometimes that means I need to pay it ahead of time, especially if I have to send it by mail. So when that happens, if a member has paid the association for future assessments, we'll report that as a liability until it's earned in that appropriate period. And then down here, we can see the equity for the association. In this presentation, the reserve fund balance is reported as a separate section of equity at $248,000. And I'm going to pay particular attention to this number in red. Not because it's red, but because it's a link. It's going to link us to the next report. That number, if you can't see it, is $11,985 negative. And the line is called net income / loss year to date. This equity section is an accumulation of net income since the inception of the entity. And this current year portion ties out, or should tie out, to your statement of revenues and expenses. So remember that number, $11,985, and we're going to go to the next slide. And we're going to see that I couldn't read the 8 right. It is actually 11,965, but it was so pixelated I could barely see it. That's my excuse. I'm sticking to it. So here we are with an $11,965 deficit. Now, I'm not focusing on the negative number. I'm focusing on the link because the income statement is giving us the performance over a period of time. Well, the balance sheet was telling us one point in time. So let me zoom back out. Here we can see from the columns, left to right, it's presenting us the year-to-date actual revenues and expenses, followed by the budgeted amount for the year-to-date. And then you can scan through the third column, which is giving us the variance. This variance is one that, as a board member, I encourage all board members to scan through this every month. Because when you spot the big variances, like we have here in our sewer and water, we'd say, gosh, we're $18,000 under budget in water and sewer. That could mean a couple things. Are we missing a bill? Or did we miss budget? Maybe we had a bad estimate. Or is this water expense seasonal? This budget was taken evenly throughout the year, yet if we have a large single-family home development with lots of landscaping that requires water, well, during the first few months of the year, as we can experience today with rain on the forecast for this week, you don't need to water as much. But when you're hitting the 100-degree temperature days, your landscaper might need to spend a lot more on water. So this $18,000 variance may be something that we'll work our way out of over time. Or it could be a red flag that we need to take a deeper look into this. And if I needed to take a deeper look, one of the required reports that we need to look at every single month is the general ledger. So scan through that. I know these board packets can be daunting, let alone the financial portion, but somewhere in that packet is going to be a report called General Ledger. And you can find that General Ledger report and then look for the account water and sewer to see all the bills that are posted there and see if something's unusual or unexpected there. Or maybe it's just a seasonal variance. The reason we look at this report is it's giving us a feel for how we're doing in terms of our offsetting our expenses with revenues. Did we assess the membership enough? And in this case, at least at this time, it looks like we're a little shy. We're about $11,900 short. However, if we go to the previous slide, well, we have $8,000 in operating left. So we don't have a lot of wiggle room for that loss to continue. When I look at these balance sheets, the first things I test, I'll take this operating checking account balance and I'll subtract the payables and the amount that members have paid in advance. In this case, it adds up to $24,000. This is a lot like a current ratio if you're familiar with finance, but I like to do that mathematical calculation because it tells me if we paid all our bills, would we have anything left? If the answer is no, your manager is probably sweating bullets every time they go to select bills for payment because they don't have enough money to pay the bills. And you need to consider that while budgeting. So let's move on. In that report pack, we have a lot of other reports that are going to be included, including bank statements from financial institutions. You want to see those bank statements on a monthly basis. You have the bank reconciliations. Stephen Murphy's favorite report, the homeowner delinquent report, because if members are not paying, we need to make sure we secure that debt and protect the other members from those who are not paying and hold them accountable. After all, they are enjoying property ownership in the state of California, even though times might be tough. A vendor invoice report or check register is also required to be included along with your general ledger. Now, this next slide shows a whole laundry list of daunting things that you might look at and be overwhelmed with, some of which is a little dated. And then it references the handbook, which has another checklist of things that you should be doing. My plea of any new board member is please at least look at the financial report packet. Oftentimes we get a new board member on and they just are intimidated by this block of paper or PDF pages that we drop on their desk, and they don't understand it. And so they say, well, that's the treasurer's job. However, it's really every board member's job. On a monthly basis, each and every board member shall review these reports. If not each and every board member, at least a subcommittee consisting of the treasurer and at least one other board member shall review it every month. And they make sure that's noted in your meeting minutes. The reason that's come about, and it relates to a story I have of a board member I met with as a prospective client. And she was concerned that the association's funds were not there. For years, she had received financial reports without a bank statement to support the balances reported, and oftentimes financial statements were missed. Well, she didn't think much of it. She didn't look or ask to see the bank statement supporting the amount of cash in the operating account for the association. And unfortunately, she found herself in a legal predicament with that company. And her association was at risk of loss of all that cash that was not in an account in the association's name. So it is serious. And I got to tell you, frauds usually aren't uncovered by an audit. Most of the time, they're uncovered by a tip, someone who tips the association off and mentions that there might be a problem. Internal audit is actually a more reliable way. As board members, just making sure that you're receiving these financial reports and at least trying to look at them can make a difference. So that's my plea. Well, yes, there's a daunting checklist. If at least you take a look, you're in a better position than if you just merely move on and address other items on the agenda. So, what's next in our presentation? Well, we're going to look at phase 3. What happens after the end of the year, which is going to consist of an accounting report and a mention of tax returns and other reports that still must be filed. Looking specifically at the accountant's report, we have 3 different levels that you might engage a CPA to provide a report on your community association financials for that year. A compilation does not require an independent CPA. However, California state law requires that if you have more than $75,000 in gross annual receipts, you must have at least a review service provided by an independent CPA on an annual basis. This review report looks a lot like an audit report. However, in the review report, typically an independent CPA is going to take a look at the internal control structure for your association. They might check for some bank statements, make sure funds are really there. However, it's mostly focused on analytical procedures. The next level up is the audit. Some governing documents actually require the association to obtain an audit, and some board members choose to get an audit for that higher standard of care. The reason an audit is more expensive and desirable is because the independent CPA is going to perform testing of those internal control systems and underlying data. They're not looking at everything, but they're going to do some testing of that data to make sure it's fairly presented. Some other reports or some other items that are important at year end include income tax, property taxes, sales tax return, and parking taxes. There are many different taxes that an association may encounter, and most of them will still be required to at least file an income tax return. Depending on the nature of the community, property tax, sales tax, and parking taxes may or may not be applicable. But make sure that you're getting somebody engaged to prepare returns for the association. Additionally, too often we see communities coming to us that haven't filed with the Secretary of State's office their information forms to comply on a biannual basis. It's not every single year, it's just every other. But that is a required report, and you can lose your corporate status if it's not filed timely. So if you miss either your tax returns or this filing, you could lose your corporate status. And I'll leave that for the attorneys to talk about what that means. Lastly, we're trying to keep it a little bit current. The CTA, the Corporate Transparency Act, seems to be in limbo at this time. But should you find out from an announcement from CAI that, oh, you do actually have to file it, please do make sure you comply with your beneficial ownership information reporting. And I bet we can count on CAI to keep us current on that through their e-blast. I've been rambling on. Stefan, you're going to take it from here.
We've got several questions waiting in queue, so we're going to fly through some of these slides pretty quickly. Distributing to owners 30 to 90 days prior to the beginning of the fiscal year. These are the documents you've got to get out to the membership, because they do have the right to and are encouraged to participate in the process. The operating budget, the reserve study summary, assessments, the collection and lien policy, and I'll stress that one, tying back into Adam saying, if you lose your corporate status, if somehow you're in suspended, which can be a very temporary status, it restricts our ability to collect and enforce certain aspects of an association's collection policy. So you still need that money coming in. There's another reason not to let your status slip. Again, even if it's just temporary. The summary of insurance within 30 to 90 days, 120 days after year end, your financial statements. So you're looking several months in advance now. Get these out to the membership so that they've got an opportunity to review them.
Next up, we have the monthly reports. We talked a lot about these already. My urge to everybody, as you heard, is please review these on a monthly basis. You're not expected to be a finance whiz. Just take a look. Ask questions of the parties that prepared them if you have them.
So
we have,
go ahead.
We were just going to talk about the first 3 bullets on this are talking about document requests. The association must reply to members requesting documentation that is required to be provided to members upon request, and they may charge a nominal fee for the costs or reimbursement of those costs. Additionally, we do have a couple things of note. You do need 2 board member signatures on any withdrawal from the reserve account, as well as on any transfers for a community equal to or less than 50 units, any transfers of funds in excess of 5,000 or 5% of the annual budget, or for communities that are greater than 50 units. And then the amounts are any transfer greater than 10,000 or 5% requires written approval from your board. Just wanted to put that out there because it was a change in the law that came up a couple of years ago, and want to make sure board members are aware that you must have that documented. And as Stefan was explaining earlier in the budgeting section, those reserve funds are for reserves, not for other operating expenses. So if you're transferring out for any reason other than to pay for major repairs and replacements, then you're creating a loan that must be repaid. We have a few minutes for question and answer.
There's some good ones in there.
Awesome. Sorry, guys. 1 second. Because I'm not on camera. Sorry. It's Monday. I'm like, why is it alerting this slide? Okay. I have recorded the questions in the order that they came in, so we are going to do them that way. In the very beginning, when you guys were talking about assessments, someone had a question, what about emergency special assessments? I'm thinking this has to do with how you prepare for assessments. Heidi, if you want to elaborate in the chat, that's totally fine.
So I think Stefan was talking about preparing the best budget you can to avoid the surprises. And so those emergency special assessments do come up from time to time. We saw a few this year, just trying to make insurance premium payments and deal with.
I have a parking garage on the peninsula unexpectedly after doing an inspection. This relates back to that Florida condo tower. They're looking at a parking structure, and they could not possibly have anticipated some significant damage to the parking structure has resulted in a $68,000 per unit special assessment. I don't know that they qualified there as an emergency, but I think at that dollar amount, they probably had to.
Heidi did
If you have
elaborate.
an emergency,
Oh, sorry. Heidi did elaborate for insurance to avoid non-renewal.
perfect. If you are working with an emergency special assessment, I do urge you to get legal counsel involved to make sure that your situation meets the criteria required. We have seen disputes over what constitutes an emergency, and since the voting requirements are sometimes different between emergency versus regular special assessments, that can become a dicey subject. But unfortunately,
and you should also include your collection provider. We're going to work with your counsel to make sure that the language that you're using in your notices to members is something that is going to be hopefully beyond reproach. We never want a disgruntled homeowner or dissatisfied homeowner to have a thread to pull to unravel the board's good work. So, bring your collection partner in at the early stages as well, after getting your advice from your own general counsel. We just want to make sure that if we've seen in what you're doing, we've seen something similar where there were some speed bumps or some potential places for that owner to unraveling your good work, we can talk to you about it before you implement the process with the membership. And that includes for insurance and the renewals and the special emergencies.
Thank you, guys. Okay, our next question is, do most HOAs use accrual method of accounting?
I would say most will use the accrual method. Some will use a modified accrual method. That modified accrual method is a hybrid approach where the revenue is recognized on the accrual basis. However, expenses are recognized on the cash basis or when they're paid rather than when the expense is actually incurred. Both are acceptable, I think, on the interim financial reports. Year-end reports will get converted to the full accrual. And then for your budget report, it's required to be on an accrual basis. So more and more, I'm seeing the trend towards just do it all in accrual basis. Maybe not with absolute perfection, but at least with that intent.
Thank you. Okay, our next question is a two-part question. One, should you budget for taxes you owe on money earned on the reserve investments? And two, if yes, can you pay the taxes from operations?
I would say there are a couple depends in there. So the argument for paying it out of reserves is that many reserve studies will actually calculate in their reserve funding plan a after tax rate of return. And so the implied message is that, well, because it's net of tax, then and the money is interest income is usually going into the reserve fund, then you should be able to pay the taxes from there and account for it there. However, I do, as a practice, we will budget for taxes in the operating budget and assess for it. There may be some positive residual effect depending on how the study was prepared, but in those cases, we pay from operating. That's particularly important when you're dealing with communities that have sources of non-membership income, which is that bank interest income and rents from third parties that is not reserve in nature. So if you're earning interest on your operating account and your reserve account, or you're receiving cell tower income that's also taxable, then paying that from reserves really, in my opinion, gets messy. I'd rather just pay it out of operating, but arguments can be made on either side.
Thank you. Appreciate the answer. Our next question is, can the board reduce the amount going to reserves to pay for an operating expense? Is this considered a loan from reserves? Is this legal?
We are not here to opine on specific legal advice for associations. However, that certainly is not the intent of a reserve fund. It's really
Good
there.
answer. Walk that line.
So please don't. I know that some associations will incur a special unanticipated operating expense and try to reduce that amount. But if you already mailed out a budget that said you're going to do it, then you're, in my opinion, you're already on the hook. However, that's a legal question. I think most attorneys I've heard tend to lean towards that's for reserves. If you're cutting from your contribution that was already distributed in the budget, then you're borrowing and you really need to come up with a plan to repay it.
Speaking of attorneys who are not going to give you legal advice, but who are going to answer your legal questions on Wednesday. So if you want to circle back on Wednesday, you can totally do that. We have one more question. We are at time, so if you do need to leave, not speakers, sorry, I'm going to hold you for the last question. But if you do need to leave, feel free. These are being recorded. And again, at the end of the day, you will be getting the handouts with all of the information that we discussed and a link to the video for anything that you missed. So our final question, and a big thank you to our speakers for that was a lot of session to go through, and financials are intense and reserves anyway. So thank you. But our last question is, how much time should it take to review the monthly financials? Because this person says they're reviewing them for like 2 hours.
I go back to my first comment, which was a plead. Too many boards trust they trust us, which is great. We want to be trusted and we are trustworthy. However, we really need to have that independent set of eyes on the financial reports. And so please at least crack it open and take a look. However, the statute does not, to the best of my knowledge, specify a time amount or allotment. And so please look it over, look at all the reports that are required by civil code. And the amount of time you spend seems to be really your preference and dependent on the complexity of your community.
I would also think that just the experience of taking a look at them every month, you should be able to train your eyes and your brain to look for the aberrations. What doesn't look right? Looking at the, what are we spending beyond what were we budgeting? Or looking at your aging report, why do we have an LLC that hasn't paid assessments in 6 months? And have we done anything about that yet? Again, it's aberrations. And so I think repeatedly looking at, even if initially it's not even really understanding what it is you're looking at, getting some advice from your management company, your accounting firm, your competent accounting firm that help guide you on what are some highlights that I should be looking at first. And then I think your mind will just quickly learn to spot those aberrations, what's out of the norm. And so I think very likely you'll be able to cut down the amount of time that you are spending on just taking a look at everything.
For the sake of the community managers out there, please do the review of these financial reports outside the board meeting. Bring your questions to those parties prior to the meeting so that in the meeting, you're actually just noting that the review was completed prior to. A 2-hour review of the financial reports during an open board meeting would be excruciatingly painful.
For all parties.
And you have access to better information if you ask outside, because then the parties can pull information for you. Whereas in the meeting, you don't always have that access.
Well, thank you both so much. That's the end of the questions that I have received. Again, please everybody come back on Tuesday at 9 a.m. for another 2 hours of education, followed by our final day on Wednesday from 9 to 11 a.m. Thank you so much, Stefan and Adam. Such a great job. Lots of information to cover in a very short amount of time. So we do sincerely appreciate your time today.
Thanks for the opportunity, Rachel. Adam, you are the man with all the information.
It was my pleasure. Thank you. And thank you to all of the participants who are spending their time to learn how to better fill their role as directors. Thank you.
Good job.
Thanks, guys. We'll see you all tomorrow morning. Bye.
Bye, everyone.